Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The dollar snaps 2 days of declines as bullish sentiment towards Asian currencies takes a breather. In China, services activity slips to a 7-month low, stoking fears of a rapid economic slowdown. A new dawn in Germany. Friedrich Merz pledges swift action to galvanize Europe's biggest economy as he takes over officially as Chancellor. Plus, a taxing problem. A new study warns the UK's plan to increase tax on wealthy foreigners could end up reducing revenues for the government. To the earnings story, breaking lines coming through from Philips, the healthcare device maker, coming through with a beat in the first quarter. Sales coming in at 4.1 billion euros. The estimates had been for just above 4 billion. So it's a modest beat, but it is a beat in terms of first quarter adjusted earnings. EBITDA coming through also above the estimates, 354 million euros for Philips. The estimates had been for around 317 million. So it's a beat on both of those lines when it comes to the healthcare device maker that has seen its stock down about 8% year to date. Commentary around tariffs, of course, and the key China market likely to be in focus. We're going to be speaking to the CEO of that company, Roy Jacobs, later this morning. Those questions, no doubt, will be put to him then, 7:30 a.m. UK time. So stay tuned for that interview with the maker of Philips as they come through with a beat in the first quarter, but all the uncertainty, of course, around the tariff impact. Let's get to the broader markets right now, because you've had that 9-day winning streak in the US being snapped yesterday with losses coming through. Modest, not significant, but you did end up lower on the day out of the US. Now it seems you are set for an end to the 10 days of upside that have come through. 10 straight days of gains for European stocks. Today, though, futures pointing lower by about 0.1%. The FTSE 100 here in the UK looking to gains of 0.2%, coming back, of course, after the bank holiday of yesterday. So a bit of a catch-up play there, arguably, for the FTSE 100. The S&P futures stateside looking to further losses after a bit of softness that we talked about yesterday, currently pointing down by 0.2%. The Nasdaq 100 stateside also looking to drop around 87 points. We did have services data out of the US yesterday. It came in stronger than expected, and markets started to pair some of their bets around the Fed, which takes us onto the currencies, because the Bloomberg Dollar Index has actually snapped those 2 days of losses, where, of course, you saw that remarkable strength come through for example, the Taiwanese dollar jumping the most in almost 3 decades yesterday. Today, euro dollar, the single currency, actually up about 0.1%, despite the fact that you have that dollar strength, again, snapping 2 days of losses. The Japanese yen as well has been significantly impacted by the flows out of the US dollar, currently at 143 in terms of the Japanese yen, largely unchanged. Brent, interestingly, bouncing 1.6%. This is a technical story, it seems, but given the lows, 4-year lows that came through yesterday, gaining on oil today. How long can this be sustained? $61 a barrel, and gold at 3,363. Let's get to the China story right now, because the data's coming through from the world's second largest economy, a private survey showing that China's services activity deteriorated more than expected in April. The latest setback, of course, for an economy already under pressure from those US tariffs. It comes as cash markets reopened in Hong Kong and the mainland after the holidays. Let's bring in our China correspondent, Min Low, for the details. Min, what stands out to you from the data that we're seeing out of China?
Yeah, in some ways, it's not surprising that we got a disappointing data from the services Caixin PMI data. That is the private survey showing 50.7 versus estimates of 51.8. This is the slowest expansion that we have seen in 7 months. It follows the disappointing data we got from the official manufacturing PMI last week, coming in at 49. The new exports order, the sub-index, that's the one we're paying attention to. That was 44.7 last week, a big contraction, the slowest since December of 2022 as well. So overall, that PMI data just pointing to possible weakness in the month going forward, because this is, of course, expectations of these purchasing managers going forward. But I think what's surprising is the trade data preliminarily holding up pretty well. The weekly data at the end of April showing shipments up 7% on year, and even air freight as well up 30% on year in the month of April. This is post-Liberation Day, which suggests that trade, perhaps with the rest of the world, with Southeast Asia, picking up and making up for that shortfall in U.S.-China trade. And if you look at Chinese markets today, onshore performing really well, big jump of close to 1%. A lot of catching up going on after markets were closed for 3 sessions for the May Day holiday. Remember that Chinese government announcing that it is considering potential for trade talk. That came out after markets were closed last week. You also have President Trump saying he's willing to lower tariffs for China. Scott Bessent this morning saying we could see big progress in U.S.-China trade talks in the coming weeks, although that doesn't really dovetail with President Trump's comment yesterday saying that U.S.-China officials have been talking about very different things. So a bit of mixed sort of sentiment there, but still we are seeing that catch-up bid both on the CSI 300 and also on the Hang Seng as well.
Mimi, you touched on the May Day holiday as well in China. What is the state of the Chinese consumer, given the data that's come through on the back of that holiday?
Yeah, so state media has been full of editorials talking about how consumption has really been very strong. And I want to break down the data for you. Official data showing 6.4% increase in total domestic trips, 8% increase in total expenditure for domestic tourists. So overall numbers looking very robust, and just eyeballing that, it looks like the per trip spending has also been increasing. Catering and retail up about 6.3%. But to break that down a little bit, look at where are the biggest jumps. They come in the sectors of cars, appliances, electronics, and these are the sectors that benefit from those consumption subsidies, which begs the question then, if those subsidies are not there, what does consumption sentiment look like? And you take a look at the box office numbers, that's where you see a big slump. About half of the box office numbers we're getting this year compared to the May Day holiday last year. Slowest growth since 2022. Remember 2022, that was the year when Shanghai was undergoing the brutal 2 months lockdown during the May Day holiday. You can see the last bar there in yellow, really half of the height of the 2024 data. Meanwhile, you have the inbound tourism data, big jump of about 170% according to Global Times. That's thanks to the visa-free policy, the tax rebate for tourists. So overall, a mixed picture, but it looks like overall numbers pretty resilient, a big part of it partly because of the supportive government policy so far.
OK, China correspondent Min Lo, thank you very much indeed for breaking down the data on the services front and the more recent numbers, of course, coming through on the back of that May Day holiday in China. Thank you. Now, the Trump administration continues to tease trade deals that could shift investor sentiment. Min was just talking about the prospects of a US-China deal. Uncertainties, of course, that were top of mind on the first day of the Milken conference. Treasury Secretary Scott Bessent argued that Trump's policies will solidify the US position as the home for global capital.
America is the Schelling point of global finance. We have the world's reserve currency and the deepest and most liquid capital markets and the strongest property rights. For these reasons, the United States is the premier destination for international capital, and the administration's goal is to make it even more appealing for investors like you.
Well, opening trade anchor Kriti Gupta joins me now for what is being said by the US Treasury Secretary and the response as well from investing executives at the Milken conference. Is the Treasury Secretary, is the Trump administration now able to win back investors and business leaders who have been whipsawed, of course, by the tariff policy? Is he tying and threading the needle on this story around tariffs versus tax cuts versus deregulation? Is he managing to convince the room that the US is still a viable place for investment?
Well, I don't think he ever lost the room to begin with. You had this idea and widespread support on Wall Street, even on the campaign trail, the deregulation and this idea of kind of this America first, attracting capital, whether it's even things like incentivizing investment in the States, would be a good idea. It's the chaos that was always going to be a big question, given the experience that so much of Wall Street had the first time around. Nobody thought that it would get even worse when it comes to the volatility or the fact that the markets would, to your point, get whipsawed by this extent. And that was the message in the room. They're still supportive of the policies. There isn't an anti-tariff narrative as there perhaps is on this side of the Atlantic, for example. But at the end of the day, they just need the chaos to end, because it's that uncertainty that's driving the losses in the market. It's the uncertainty that's stopping corporates from hiring. It's the uncertainty that's ultimately stopping fund managers even from making widespread decisions. And that was the narrative from the likes of Mark Rowan, Henry Kravis, and some of the other bigger players at Milken.
And one of the nations that have been hit by this uncertainty when it comes to the tariff story is, of course, Canada. We have the new Prime Minister, Mark Carney, being elected with that significant win, of course, in Canada. He's going to be meeting with President Trump later today. What is on the agenda, given some fiery rhetoric on both sides leading up to that election in Canada?
Well, this was supposed to be the closest relationship in the world between Canada and the United States that has completely turned sour. And I think this is really crucial when it comes to what kind of litmus test and what kind of negotiations Mark Carney can actually get out of Donald Trump for the rest of the world. This is not only a bordering country. You know, Mexico's Claudia Sheinbaum is also as a part of this kind of cohort of trying to negotiate. She made comments yesterday as well in terms of the progress of those trade deals. But for Mark Carney, it's twofold. One, it's the question of sovereignty, because, of course, the idea of a 51st state has been met with quite a bit of pushback, unsurprisingly, in Canada as well. But also questions of shared industry. So the auto sector is a key one there, where so much of the auto manufacturing that happens out of Detroit is partially then using workers from Canada that kind of make their commutes back and forth, the auto parts that go back and forth, but also the energy infrastructure and Canadian oil and gas, I should say, that has struggled in the past when it comes to infrastructure to get into the United States. So that end buyer of oil at the same time that the U.S. is obviously dealing with its own oil industry are going to be two key parts among a series of other things like free trade agreements of the USMCA, the former NAFTA deal, and what that cooperation with Claudia Sheinbaum looks like in Mexico.
Yeah, and the consequences of some of these policies already being felt, of course, in Canada with the closure of some of those plants in and run by GM. So no doubt that will be part of the conversation as well. Kriti Gupta, thank you. Opening trade anchor Kriti Gupta on what we can expect from that Carney-Trump meeting later today. And, of course, what we've been hearing from the US Treasury Secretary Scholz. Bessent. Now, the dollar regaining some ground. This all ties together, of course, in Asia after its two-day slide. Central bankers from Taiwan and Hong Kong said to have intervened in the market. Let's bring in Bloomberg's Valerie Taitel, who's been following all of this very closely with a lens for us. What's behind the latest moves then? Is this the end of the remarkable strength that you were highlighting for us yesterday?
Tom, I wish I knew the answer to that, but that is still very much uncertain. What we know is that the Taiwanese dollar has stabilized after such a rapid appreciation in the last three sessions. We're only 0.4% stronger versus the dollar today. But take no note, Tom, the last two sessions for the Taiwanese dollar has set records for the amount of rapid appreciation that we have seen. We are still over 6% stronger in the Taiwanese dollar in the last few sessions, and speculation is still rife. This marks a policy change by the Central Bank of Taiwan. The fact that they let this appreciation happen so rapidly means they could be willing to let it happen more in the future. There is also still a conclusion out there, Tom, that Asian FX appreciation could be the direct consequence of these trade deals currently being negotiated with the Trump administration. We do await the first trade deal. Maybe it'll come sometime soon, but we are stabilizing across Asia FX, Malaysia, Singapore, and China, all seeing a decent weakness today on the back of this.
OK, so from the FX markets to what's happening in equities, your heady excitement, Val, as the S&P just notched up win after win. Nice straight days of gains, but it's all come to an end.
It has. The S&P 500 has ended its historic winning streak. 9 straight days of gains came to an end yesterday, where the S&P fell around 0.6%. But over the last 10 days, Tom, we are still holding on to some decent gains for the index. I do want to note there was some after-hours movers basically on earnings. We had two out that are basically signaling a softness ahead for the U.S. economy. We had Ford pulling their guidance and warning of a $1.5 billion hit to their bottom line from tariffs in this current year. Also heard from Palantir Technologies. This is the defense-focused tech company. They gave a weak forecast ahead, and that share fell over 9% in after-hours trade.
OK, Bloomberg's Valerie Taitel, thank you very much indeed on the markets, FX, S&P 500 and some of the individual names as well, Ford and Palantir. Talking of which, we're going to get more of a lens in terms of what's happening across the auto space later today. 6:30 a.m, so in about 16 minutes or so. We're going to get the earnings coming through from Continental, of course, the auto parts maker, and that will be consequential in terms of what they say about the impact of tariffs, of course. So we'll break those numbers for you in just over 15 minutes' time. We'll get more on the auto space, but a different segment with the earnings coming through from Ferrari before the US markets. The recent quarter is meant to be, in fact, one of their best ever, but to what extent can they continue to pass on, or will they pass on those tariffs to their US consumers? Will they be able to absorb that 25% tariff. But those recent earnings are going to cross later today, just before the US market. We'll break those for you as well. And on the geopolitics, we've been touching on this. Trump meeting with Carney, high stakes meeting. Arguably the first time, of course, the two have met since Mark Carney was elected as the premier over in Canada. That meeting later today, which we will continue to cover for you as well. We're going to focus on what's happening in terms of technology, with OpenAI backtracking on its plans to become a more conventional for-profit company. We'll give you the details and what the implications are. That's next. This is Bloomberg.
After a pause in March, a Bank of England rate cut is back on the cards at the next decision day. And markets will be listening to Governor Andrew Bailey for clues on the outlook as the UK grapples with the impact of President Trump's tariffs.
We are certainly now in a world of even greater uncertainty.
Tune into Bloomberg for live coverage of the BOE decision and press conference. It all starts Thursday at 12:30 p.m. on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Happy Tuesday, everyone. OpenAI is backtracking on plans to become a more conventional for-profit company. A focus right now on what's happening in AI. That's after facing pressure from former employees, academics and rivals, including none other than Elon Musk. For more, let's bring in our tech reporter, Annabelle Drulis, for the details on this story. Annabelle, this has been a painful attempted adjustment from OpenAI, with all those different pressure points coming to bear, whether it's Elon Musk or Microsoft. Where do things stand right now in terms of our understanding of what they're hoping to achieve in terms of reshaping, restructuring this business?
Yeah, it's kind of interesting because actually where things stand today is pretty much where they were standing for several months now, but I think we can just give a little bit more context here. So last year in December, people may remember, but there was a lot of issues within the leadership of OpenAI as to the structure that it was taking, because OpenAI was essentially founded as a non-for-profit, and then a few years later, it was also sort of restructured to have a for-profit subsidiary that sat underneath the umbrella. That was causing issues because the likes of Sam Altman, for instance, were wanting to go out and seek further investment. And so they wanted to restructure the business for the for-profit to sit at the top. But as you said, they've received a lot of feedback from civic leaders. They've had different officials, public officials they've spoken with. Elon Musk has been very, very public about this as well, the direction that the company was looking to take. And so as a result, the company is now saying that it will keep the non-for-profit structure, that umbrella structure, in place. So it takes it back, or effectively maintains the same contours as how the company was established. That said, the company is still looking to make some adjustments, and it also does face a little bit of pressure from businesses that it's working with as well, because as part of its latest funding round, where it took in $40 billion, the company got more investment from SoftBank Group, and they actually have the ability to dial down their investment from $30 billion to $20 billion if the restructuring isn't complete by the end of the year. But essentially, as you said, it is going to keep that non-for-profit structure largely intact, it seems, right now.
OK, and as you say, we'll monitor what that means for the flows of funding and investments from SoftBank through the end of the year then. Meanwhile, on another segment, another part of the AI story, this is Palantir coming through with their earnings. What do the numbers tell us about demand for Palantir's products?
Well, this one is more about sort of not living up to expectations, I would say. We had the Palantir results out, and actually the company fell about 8% in late trade, but the numbers were pretty strong that the business reported. I mean, when you take a look at them, for instance, revenue for the quarter jumped nearly 40% to $885 million. That beat even the highest of analysts that we had surveyed for it. The company's also bumped up its 2025 revenue forecast to about $3.9 billion. It earlier had seen $3.75 billion. So that, again, is growth of around 36% on the year. So there is a lot of strength and demand for its AI software in particular. particular, and it's got a very large contract, for instance, with the US military. They're also saying they've added NATO as a new customer. So that's really the upside. It's that strong growth that you're seeing, particularly in North America. But to the downside, and this is also what's been pointed out by our Bloomberg intelligence team, they're saying that essentially there is a really tepid enthusiasm in the rest of the world, and that's the big cause of concern here, because even though international customers make up less than a third of their revenue, it's still significant. At the same time as well, when you don't have enough clarity around the new drivers of the business, that was also flagged as another issue. And large language platforms like OpenAI and Anthropic, for instance, are continuing to expand their own enterprise AI software offerings, and so that possibly could dent Palantir's gross margins moving forward. But I think also part of it you can see here, I mean, up more than 60% year to date, the stock. It's a really top performer in the NASDAQ. It's trading at very expensive valuations. And, we've seen this time and time again. You just fail to live up to the hype, basically.
Yeah, that is one of the key kind of takeaways from these set of earnings, given the beat that came through in the raise to forecast for Palantir. Tech reporter Annabelle Drewlers, thank you very much indeed with our AI wrap for the day. Now, coming up, Treasury Secretary Scott Bessent makes his pitch to investors at the Milken Institute conference as he defends Donald Trump's trade policies. We're going to bring you part of that speech next. This is Bloomberg. Treasury Secretary Scott Bessent has touted the US as the premier destination for global capital while defending Donald Trump's trade policies. He spoke at the Milken Institute Global Conference.
America is the Schelling point of global finance. We have the world's reserve currency and the deepest and most liquid capital markets and the strongest property rights. For these reasons, the United States is the premier destination for international capital, and the administration's goal is to make it even more appealing for investors like you. This morning, I will explain how we plan to achieve that goal. The primary components of the Trump economic agenda, trade, tax cuts, and deregulation, are not standalone policies. They are interlocking parts of an engine designed to drive long-term investment in the American economy. Our goal with trade policy is to level the playing field for our great American workers and companies. With a level playing field, American industry can outcompete all challengers. Tariffs are engineered to encourage companies like yours to invest directly in the United States. Hire your workers here. Build your factories here. Make your products here. You'll be glad you did, not only because we have the most productive workforce in the world, but because we will soon have the most favorable tax and regulatory environment as well. This is where tax incentives and deregulation come into play.
Treasury Secretary Scott Bessent. And Bloomberg TV and radio will have plenty more from the Milken conference this week. Do not miss that coverage. The Trump administration, meanwhile, has blocked Harvard University from new federal research grants. The move could affect over $1 billion annually, and the Ivy League school would need to enter a negotiation with the administration to resume eligibility. Harvard has come under fire from President Trump and his allies, who accuse it and other elite universities of ideological bias. A Harvard spokesman called the move illegal. Coming up, we will move from the US to what's happening in Germany. It's expected, it's been known about, but it is nonetheless a significant chapter in that country's history. Friedrich Merz taking over as German Chancellor later today. We will be live from the Bundestag to discuss the challenges facing Europe's largest economy and what the policy priorities of the new Chancellor will be. That is next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The dollar snaps 2 days of declines as bullish sentiment towards Asian currencies takes a breather. In China, services activity slips to a 7-month low, stoking fears of a rapid economic slowdown. A new dawn in Germany. Friedrich Merz pledges swift action to galvanize Europe's biggest economy as he takes over as Chancellor. Plus, a taxing problem. A new study warns the UK's plans to increase tax on wealthy foreigners could end up reducing revenues for the government. We'll bring you some earnings right now with a beat coming through from the German auto parts maker Continental coming through with a beat on its margin in the first quarter. 6% is the number versus the estimates of 5.2%. In terms of first quarter sales, also a beat, 9.7 billion euros. Revenues for the full year. This is the forecast then amid all the tariff uncertainty, the impacts, of course, on that auto sector. They see full year revenue of about 19.5 to 21 billion euros from continuing operations for the full year. They see revenue of between 18 to 20 billion euros for the full year. Any commentary, of course, on those tariffs and the impacts on the broader auto industry will be watched for. But it's a beat in terms of the first quarter margin for Continental. We're going to be hearing from the CFO of that company, Olaf Schick, later this morning. That interview is at 8:35 UK time on the opening trade. So stay tuned for that conversation. Let's get back to the markets then. European stocks look set to break that running streak. 10 days of gains for European equities set to be broken today, with losses flagged of about 0.1% for the Stocks 50 futures. FTSE 100 futures pointing to gains of 0.2%. We build up, of course, to the expected cut in interest rates from the Bank of England later this week on Thursday. S&P futures, meanwhile, looking to losses of 0.3% after snapping 9 days of gains yesterday. Nasdaq 100 futures pointing lower by 107 points. Let's flip the board and have a look. Cross asset, no treasury trading today because Japan is on holiday, but the focus is on the FX space with the incredible strength that you've seen in some of those Asian currencies ebbing and easing today, with the dollar back in positive territory. Euro dollar at 113, the single currency currently at 113. The Japanese yen at 143, largely unchanged. Brent picking up in terms of oil prices after falling to a 4-year low yesterday at 1.6% is the gain in oil prices today on Brent. And gold currently at just 0.7%. So let's get to the German political story of the day. Friedrich Merz vowing to hit the ground running when he takes over as German Chancellor later today, with a stagnant economy, war in Eastern Europe and support for the far-right AfD strengthening. Mr. Merz will have a full in-trade. The DAX closing just shy of a record yesterday. Bloomberg's Oliver Crook is at the Bundestag in Berlin for us. Ollie, tell us an outline for us what Merz's priorities will be as German Chancellor.
Yeah, for this new chancellor coming in, Friedrich Merz, who's going to be sworn in a little bit later today, there will be the official transfer of power from Olaf Scholz to Friedrich Merz at about 3 p.m. The Bundestag will vote in about an hour and a half's time, and that will kick off the process to basically replace the chancellor after this long period of time between the collapse of the government and bringing in the new government. And we should say, Tom, that this is a government that is characterized and maybe defined by the sort of historic move to loosen the debt brake and to unleash basically €1 trillion worth of spending. The real question is going to be one of speed and effective deployment of that amount of money. I mean, we should say, Tom, we think about this process that began in Germany. This happened the day that Donald Trump was elected president of the United States. That's when the German government collapsed. Now, 6 months later, we're getting a new chancellor and beginning to hit the ground running. Again, the concept of time and the speed at which Germany is able to deploy this is going to be the big sort of operative question. We should say that the ministries will also be very crucial. The foreign ministry and the economy ministry, those will be held by the CDU, and then the SPD will hold the finance ministry and the defense ministry. The reason that matters, Tom, is because these are going to be the key ministries in terms of dispersing those funds. But we should also say there is another sort of backdrop here. There is the question of immigration. This is going to be front and center for the German population and for Friedrich Merz. This is going to be a government that is defined by looser spending, looser fiscal spending, and tighter immigration policy. The question is the speed at which they're going to be able to deploy this at a time, Tom, when we are seeing now the AfD, since the election, they've only gained in the polls, and in many polls, for the very first time, the AfD is the #1 party here in Germany.
On the AFD then, and this is causing already controversy and pushback from the US, interestingly, the likes of J.D. Vance, of course, the vice president. Yeah. The question of how Merz deals with the AFD, and that has become a prominent question.
Absolutely. I mean, we just on Friday had this report from the sort of agency that is slated, that is sort of responsible for preserving German democracy, preserving the Constitution. This is something that was established after what happened in fascism, in Germany and, of course, the Soviet times as well. This is the sort of agency that is a neutral agency that put out this report on Friday, a 1,000-page report that basically classified the AFD, the entire party, not just parts of the party, as has happened historically, the entire party as basically an extremist movement that they can monitor. There have been calls potentially to ban this party. This is something that we should say has been sort of received by the mainstream very sort of reluctantly, because banning a political party is something that is obviously very, very sort of a high bar to do, and something that can cause a lot of controversy. And I'll just give you the reasoning as to why the German spy agency has classified them. They say that the party's prevailing understanding of people based on ethnicity and descent is incompatible with free democratic basic order. It aims to exclude certain population groups from equal participation in society and subject them to unconstitutional and unequal treatment. Of course, the AFD says that this is entirely politically motivated, that this is something that is basically the mainstream parties being uncomfortable with the AFD and trying to block them out. And that is a sentiment that has been reinforced by Marco Rubio, the United States Secretary of State, saying that Germany just gave its spy agency new powers to surveil the opposition. That's not democracy. It's tyranny in disguise. So that is the sort of rising pressure that you have here in Germany in the backdrop. And for Friedrich Merz, if he wants to sort of get things going, he's not a very popular politician, we should say. He needs to deal with this immigration question, and that is going to also cause problems across the EU. So Friedrich Merz needs to deal with immigration, establish himself as a sort of big leader within the European Union, and of course deploy this capital and turn this economy around.
Yes, quite the intrigue, even if you do have that fiscal spending power at your disposal. Bloomberg's Oliver Krupp at the Bundestag for us in Berlin, ahead, of course, the expected swearing in of the new Chancellor of Germany. Now, staying on topic with a lens now on what's happening in the auto sector, because, of course, the macro front in Germany, the automakers, they're impacted by what's happening in terms of the tariff story. The trade war's fallout on the auto sector is in focus, of course, this morning with the German car parts maker Continental reporting earnings and Ford pulling its full-year guidance. Charlie Wells is here with an update in terms of what's rippling through the auto sector. Continental numbers then dropping about 7 minutes ago, Charlie. Sales jumping to the best in the first quarter, the best first quarter in 4 years. So I guess the question is this as good as it gets for the auto supply maker, given the tariff impact?
Well, look, this is a company that has been trying to go on a more positive trajectory, right? They are focusing a lot more on their more profitable tire unit. So this is the sort of beat that they need. They more than doubled their earnings in the quarter, and they really have been focusing on cutting costs at this less profitable auto parts unit. They're planning on spinning that out. They're planning on spinning out an industrial unit as well, and really focusing in on tires. And this is a really interesting strategy because they face a lot of headwinds. They've, of course, got these trade and tariff headwinds. That is going to be a challenge for them. But they also have this issue of the fact that as the economy, as the car market transitions more to EVs, those require fewer parts, but they still require tires. So this is sort of a part of the strategic unit that this company is going for, and this is the kind of earnings beat that they really needed.
OK, it's kind of an interesting back to basics then for Continental. Tie that story to what we heard from Ford yesterday, particularly the pulling of their guidance for the full year.
Well, we're just getting more clarity on how this trade war is kind of spilling through the automobile market. And they did, like a lot of their peers in the automotive sector, pull that full year guidance. Their CEO talked about how there was just too much uncertainty, that they need to be patient to see how a lot of this policy plays out. But they also said that there would be a $1.5 billion hit to their earnings in 2025. That is not great, especially when you consider the fact that Ford, they actually have a little bit less of a tariff hit than some of their U.S. competitors because they produce about 80% of the vehicles that they sell in the United States domestically.
Ferrari, different segment of the auto market, coming through their earnings later today as well. Are they resilient given the wealth of their customers to what is happening in terms of the tariff impact?
Tom, if you're going to be a car company in the middle of a trade war, Ferrari is the company that you want to be. Because, look, their U.S. market is their biggest market. 1 out of 4 vehicles they sell in the United States. They produce all of their vehicles in Italy. So in the middle of a trade where you'd think that would be a tension, but yes, it is that wealthy consumer. Their consumer makes at least $1 million per year. So they are sheltered from a lot of this. They would be able to pick up that hit. And this is something that should boost Ferrari. We're expecting to see a strong quarter when those earnings drop later this morning.
Bloomberg's Charlie Wells with that wrap of what we're seeing in the auto sector and the tariff impact as we look ahead to Ferrari earnings. Charlie, thank you. To a different segment right now, earnings dropping from the wind turbine maker Vestas. They actually have modestly upgraded their views on the full year. Full year revenue now seen at the top end, coming in at 20 billion euros. The estimates had been for 19.07 billion. So the range is between 18 to 20 billion euros. That is their view on full year revenue for 2025 coming through from Vestas. In terms of what they're seeing on adjusted margins, they also see at the top end of that range a higher margin coming through full year than the estimates. So the range of between 4 to 7% on full year adjusted margins for Vestas. The estimates have been for 5.71%. So at the top end, that's coming in slightly higher. Those numbers coming through from the wind turbine maker Vestas. Now, Apollo Global Management CEO Mark Rowan is backing President Trump's economic goals, but he tells Bloomberg the US also risks slowing the economy if it doesn't resolve the uncertainty around trade policies.
What the administration wants to do, in my opinion, is not wrong. We are the freest trading country in the world and have been since the end of World War II. It is not clear to me that we have to be, or that we should allow allies and strategic competitors to inhibit our access to their markets. We can take issue with how it's being done and the uncertainty it's creating, but the president and the administration start with a really strong hand. Low unemployment, good job growth, massive capital investment over the last 4 years and continuing in the U.S. So now is actually a good time, but we have uncertainty. And in the face of uncertainty, people do not make new investments, they do not hire, they do not make moves. We likely will cause 2 quarters of negative growth if we, in fact, don't resolve the uncertainty. So until we have resolution of what the rules of the game are, it's going to be slow.
A lot of people talk about the potential for a recession, but little are people talking about the severity that could exist in the potential for a recession.
Look, now we're talking about forecasts and projections. In our firm, when we were raising rates 300 and 400 basis points, we talked about a non-recession recession, which is a correction in asset prices, but not necessarily in labor. We kind of see the same thing happening again. It's not to say we won't have some fallout and some adjustment, but we're starting from a place of 4% unemployment, good job growth. We are building infrastructure, we're building semiconductor plants, we're absorbing massive amounts of foreign direct investment. Like it or not, we're building Inflation Reduction Act factories. And now the president is channeling capital from around the world to come back here. Some days I wake up and worry about capital. Most days I wake up and worry about where will we get all the people to do this.
Apollo Global Management CEO Mark Rowan speaking with Bloomberg's Sonali Basak at the Milken conference. Coming up, a new study warns the UK's plan to take more tax from the rich could cost more than it raises. We're going to bring you the details on that research next. This is Bloomberg. Welcome back. The UK's tax overhaul for wealthy foreigners will start costing more than it raises if 1 in 4 of those affected leaves the country. That is the warning from the Centre for Economics and Business Research. The government disputes those figures. Bloomberg's James Walcock has been looking into this for us. James, why could this be such bad news for the UK government, given the adjustments around non-doms, the need for this government to raise revenue? This could end up backfiring ultimately.
Yeah, so the Centre for Economics and Business Research say 2 things. First, the OBR, when they were drawing up the forecast for this policy, took the wealthiest of the wealthy when they were putting the sums together and estimated it would generate 1.4 million per non-dom. The CEBR say it's close to about 600,000 by looking at past tax receipts. So it's not going to make as much as the government thinks, 1. 2, the the estimates of how many people will leave in response to the higher taxes vary drastically. The OBR say it's 12%, Oxford Economics put it at 32%, some private wealth managers say they've surveyed people and go as high as 60% based on their surveys. The CEBR put all this together and go, by their analysis, if 25% of non-doms leave, 1 in 4, that's the point at which the UK government starts losing money. This is a big deal for the government because they've said this is a good thing to do, but they also have said this will raise £33 billion over this Parliament, figures they stuck to when we put this report to them. And so if the CEBR are right, this starts becoming a headache rather than a bonus.
And that doesn't seem like a stretch, 25%, given the range of outcomes that you outlined, 12 to 60%. They've landed on 25% as the potential impact in terms of those leaving, and we'll see what the details are. Where are those wealthy who are affected by this? Where are they leaving to? Where is the pool?
Well, you've got your greatest hits. I mean, we have already seen the Livingstons, which are big real estate magnates, say they're going to Monaco, Switzerland, the Bahamas. They are standard ones. But what's fascinating is, although we don't get any numbers for this yet, Tom, we won't get them for at least 2 years, we're starting to get anecdotes. And Goldman's Richard Nodde, he said he's moving to Milan. And that's fascinating because we're now seeing European countries like Italy, Greece, they're trying to compete for some of the wealthiest. Italy have put in a flat rate of €200,000. Pay that, you don't have to pay income tax on your foreign assets. Greece, if you invest €500,000, just pay another flat rate of €100,000 a year. Or you could move to Dubai, big favourite, because you don't pay any income or wealth tax. There is a fight for the mega wealthy, and the UK's taken the chance to say it will charge its residents more tax to stay in the country. They might leave.
To the argument that the UK offers particularly attractive appeals when it comes to what this nation offers, whether it's the private schooling system, whether it's the attractions of London, whether it's the standard and quality of life versus somewhere like the UAE or Italy. Do we understand how that is feeding in to the decision-making coming through from the ultra-high net worth individuals that we're talking about? You named some prominent individuals, but how do we have clarity on how that is being factored in as part of this conversation, part of this debate, part of this decision-making?
The simple answer is we don't. I mean, like, it does matter. You want the good schools, you want somewhere for your kids to live, all these kind of non-data dependent variables, but we won't get any data from HMRC, which is where you declare, for at least 2 years. And so in the meantime, all we have to work on are estimates, which you've gone through, anecdotes, which are people going, and precedents, which is where in Switzerland, when they put in a similar kind of tax change, over 5 years, 30% left. But in the meantime, it's all just guesswork, but it's guesswork that leaves the government facing a potential £1 billion hit right at the moment where they are extremely fiscally stretched.
James Walcott breaking that story down for us very nicely indeed. You can read more, of course, on Bloomberg.com and, of course, on the terminal. Now, Bloomberg has learned that Italy's government is unwilling, talking of Italy, to soften conditions imposed on UniCredit's bid for Banco BPM, potentially prompting the firm to pull the deal. We understand that Rome does not currently see any reason to make it easier for UniCredit to buy the smaller rival, and it's unlikely to change the restrictions it set out last month. Other sources tell us UniCredit is likely to withdraw its bid if the government does not change its mind. There's plenty more coming up. Stay with us. This is Bloomberg.
Tomorrow, the Fed decides.
It is the central banker's dilemma. Downside risk to growth, upside risk to inflation.
They are wait.
This is a serious moment. I do not think the Fed can just sit on the side.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
They are expecting stagflationary-like environment.
They are going to be on hold until they have hard evidence one way or another.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
What the administration wants to do, in my opinion, is not wrong.
He, I think, did the right thing in pausing tariffs, the reciprocal tariffs for 90 days. And I think the next step probably should be, I call it a 180-day pause, take down the China tariffs.
You can sort of see the administration walking back some of the more novel ideas they've come up with. To quote Queen Elizabeth, just stay calm and carry on.
The level of engagement everywhere around the world is absolutely tremendous. It's about scenarios right now. It will turn into action further down the year.
Well, some big names in US investing, of course, weighing in on President Trump's tariffs at the Milken conference in Beverly Hills. And the tariff impact, of course, has undermined that status that the dollar has had as a safe haven. Have you seen that ripple across, of course, the Asian FX markets, most probably in the last 2 trading days, with some massive moves, for example, in the Taiwan dollar that we've been highlighting for you in the last 2 days. And you saw that move, the biggest jump that we've seen in about 3 decades yesterday. Some of that is eased today because the dollar has snapped those 2 days of losses, and the Bloomberg dollar index is currently up in the session, and so you're seeing a little bit of easing. The central banks, though, of Taiwan and Hong Kong have been stepping in. We've seen record buying of the US dollar by the Hong Kong authorities and the Taiwanese central bank as well, bringing together some members of their institutions, of course, to try and assure them in terms of the direction of travel. But some of this is built into expectations that maybe you get some trade deals in the next few weeks coming through with the US administration. So we continue to keep an eye on some of that FX volatility. This is the EM FX space at record highs. Talking of Asia, let's bring in the data coming through from China then. Services data, and this is possibly where Trump is going to smell blood on the weakness that you're seeing in the Chinese economy. On services, manufacturing, exports, of course, those are under pressure. The latest data from services, the Caixin survey, that is the white line, aligning with what we're seeing in terms of the official non-manufacturing survey. You're still in expansionary territory above 50, but this is at a 7-month low in terms of services. So that engine also sputtering in China, suggesting that maybe the second quarter is going to look very weak, given the relative strength that came through in the first quarter. Most economists now surveyed by Bloomberg expect growth for this year to be around 4.2%. That's well below the target of 5%, the official target, of course. Let's get to the earnings story. Palantir, of course, with that finger and that gauge on what is happening in terms of the pulse around the demand around AI, particularly from the security services and defense, with the big contracts around the Department of Defense, of course, stateside. Coming through with earnings that actually beat in the quarter. They actually upgraded their forecast. They see about an increase of around 36% for the year in terms of revenues. But nonetheless, of course, after hours, pressure on Palantir. This is a question of missed expectations because this has had such a decent run-up in terms of the stock price year to date. Question marks about the international sales picture for them and the pipeline going forward as well. But again, they've raised their forecast and they came through the beat. Nonetheless, a bit of selling pressure coming through for Palantir. Ford in the auto space, $1.5 billion could be the hit to tariffs. They have pulled their full year guidance. Coming up, we're going to be speaking with the Philips CEO after that company lowered its profitability outlook. Questions, of course, about the China market, questions about the impact of tariffs on that healthcare equipment maker. We're going to hear as well from the CFO of Continental, back to the auto space after it more than doubled earnings in the first quarter. So stay tuned for those conversations. The opening trade is up next. This is Bloomberg.